What is shareholder in business? For profit, public traded corporations can raise money by offering investors shares in exchange for a portion of the business. The money spent on buying shares as part of an initial public offering (IPO) goes straight to the company. Companies naturally no longer make money from those transactions after they are traded among shareholders. The money raised from the sale of shares can be used by the company to fund operations. In general, as a shareholder, you have the freedom to keep your shares for as long as you choose. The future success of the business has a significant impact on the value of the investment. Despite the fact that there are numerous reasons that can cause a stock price to rise and fall, in general, the more successful a company is, the more your shares may increase. If a firm struggles, the value of your investment may decline. Any person or organization, institution, corporation, etc., with sufficient funds to buy one share may join as a shareholder. While officially becoming owners, shareholders are not in charge of managing the day-to-day operations of the company, unless they also happen to be employees. Additionally, they are exempt from any direct obligations associated with running a firm. Equity shares can be bought in two basic categories: common shares and preferred shares. The most popular option for the typical investor, common shares are appropriately called and typically grant shareholders the power to vote at the company's general meetings. Companies may issue different classes of common shares, such as Class A and Class B, with varying voting rights. The majority of firms issue common shares with voting rights, but some also issue non-voting shares, which provide holders little to no voting power on corporate matters. Common shareholders are entitled to dividends if a company declares them. Of course, management has the authority to change, enhance, or decrease these dividends at any moment. Some businesses decide to distribute some of their profits as dividends to shareholders, while others decide to reinvest those funds back into the business. Shareholders can learn more about a company's operation at annual shareholder meetings, which are typically open to all shareholders with voting rights. Voting by shareholders may occur in person at the meeting, by mail, or in some circumstances electronically. A few significant ways set preferred shares apart from common shares. First, owners of preferred shares often do not have voting privileges, and the shares typically have lower potential for capital growth. However, dividends paid on preferred shares are set, consistent, and typically higher than dividends given to common shareholders. That's all for today's video. Let me know your thoughts in the comments section. Like, share, and subscribe.